The long straddle requires a stock to move more than market makers expect, while the Iron Condor profits when fear is high, but the stock price actually goes nowhere. Traders often confuse direction with volatility. Today we compare the ultimate volatility buying strategy, the long straddle, against the premier volatility selling strategy, the Iron Condor. The long straddle involves buying both a call and a put at the same strike price. You are making a directional neutral bet that the stock will make a massive move, but you don't care which way. In contrast, the Iron Condor is a defined risk strategy where you sell an out-of-the-money call spread and an out-of-the-money put spread. You are betting the stock stays within a specific range. The profit profiles are mirror images. The straddle has unlimited profit potential but costs a lot to open. The Iron Condor has capped profit, but you receive a credit up front to open the trade. The critical difference lies in the expected move. Market makers price options based on how much they think the stock will move. When you buy a straddle, you are fighting against this math. To break even on a straddle, the stock must move more than the total premium you paid. If the options are expensive due to hype, that break-even point becomes incredibly hard to reach. This leads us to implied volatility, or IV. High IV means options are expensive. If you buy a straddle in high IV, you need a catastrophic move to profit. If IV drops, you lose money even if the stock moves. This is the IV crush trap. Buying straddles right before earnings is risky because once the news is out, uncertainty vanishes and option prices collapse instantly. The Iron Condor thrives in that exact environment. Because you are a net seller of options, you want IV to start high and then collapse. You are selling fear to other traders. Time decay, or Theta, also separates these strategies. Every day the market doesn't move, the straddle loses value. The Iron Condor, however, gains value every day the stock sits still. However, the Iron Condor has a major weakness, gamma risk. If the stock makes a massive move through your short strikes, your losses can mount quickly up to your defined cap. So how do you choose? It comes down to volatility rank. This metric tells you if current premiums are cheap or expensive relative to the past year. When IV rank is low, options are cheap. This is the time to buy straddles. You are paying a low price for the potential of a volatility expansion or a breakout. When IV rank is high, premiums are rich. This favors the Iron Condor. You are collecting a large credit, which gives you a wider break-even range to be wrong. Let's look at probability of profit, POP. Iron Condors usually have a high POP, often 60 to 70%. Straddles usually have a low POP, often under 40%. This math dictates your position sizing. Because straddles lose more often, they must be managed aggressively. Condors win more often, but one bad loss can wipe out several wins. Scenario 1. A biotech company pending FDA approval. The stock will either double or crash. Volatility is already expensive, but the move could be 50%. In this binary event scenario, a straddle might still make sense despite high costs, because the realized move will exceed the implied move. An Iron Condor here is suicide. Scenario 2. A stable blue-chip stock reports earnings. IV is elevated, but the stock historically moves less than 3%. This is the textbook Iron Condor setup. Here, you sell the high premium. Even if the stock jumps 2%, the IV crush and Theta decay will likely allow you to close the Condor for a profit the next morning. Management is the final piece. Managing a straddle usually involves taking profits at 25 to 50% quickly. Do not hold straddles to expiration unless the move is massive. For Iron Condors, you must defend the tested side. If the stock challenges your call side, you might roll up your puts to collect more credit and reduce risk. To summarize, use long straddles when IV is low and you expect a violent wake-up call. Use Iron Condors when IV is high and you expect the market's fear is overrated. Choose straddles for cheap explosions, condors for expensive stagnation.